Let's know about some finance terms. Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of securities like stocks, bonds, and other assets. These funds are managed by professional fund managers employed by asset management companies, AMCs. A hedge fund pools money from private investors and is managed by professional fund managers. These managers use various strategies, such as leverage, borrowed money, and trading non-traditional assets, to seek higher than average returns. Hedge funds use various trading techniques to invest in securities and assets, including derivatives like futures and options traded on stock exchanges. Derivatives are financial instruments that derive its value from an underlying assets. These underlying assets may be stocks, bonds, commodities, and currencies. Private equity, PE, is an asset class and investment strategy involving investment in the equity of privately held companies or taking public companies private. PE firms pool capital from investors to acquire these companies, aiming to improve their operations and ultimately sell them for a profit. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specific date. Futures are standardized contracts to buy or sell an asset at a predetermined price on a specific future date, making them a type of derivative. These contracts are traded on exchanges and obligate both the buyer and seller to fulfill the agreement, regardless of the current market price at the time of expiration. Swap is a derivative contract where two parties agree to exchange cash flows or liabilities over a specified period. These exchanges can involve various financial instruments, like interest rates, currencies, or commodities. Swaps are primarily used for risk management, speculation, or restructuring debt obligation. Blue-chip stocks are shares of large, well-established, and financially sound companies that have a long history of consistent performance and strong market leadership. They are known for their stability, reliability, and ability to withstand economic downturns, making them attractive to investors seeking lower-risk investments. An IPO, or initial public offering, is when a privately held company offers shares of its stock to the public for the first time, transitioning it from private ownership to public ownership. This allows the company to raise capital and become listed on a stock exchange, making its shares available for trading by the general public. Arbitrage is the practice of simultaneously buying an asset in one market and selling it in another, or in a different form, at a higher price to profit from the price difference. It essentially involves exploiting temporary price discrepancies for a risk-free profit. Thanks for watching.